Hello traders, today we're going to cover and review some of the points that we did on the live webinar. If you were unable to attend the live webinar that just occurred, we'll have a new one this week. We're going to be covering forecasting, price action, slow markets, fast markets. So I'm going to use this time here in this video to go over the key points in case you were unable to attend. So lately we've had some slow market, some slow activity in the market, unlike what we've seen previous 2-3 years, which has been very strong volatility, and there is a difference. And how do you know how to trade the targets, the stops? So the first thing that I covered during this live webinar is to understand whether or not the market is slow or fast, and whether or not we should be using a 5-minute chart, 10-minute chart, hourly chart, and so on. So the first thing here that we should do is just do a bit of a comparison. So this is pre-market right now. The market's about to open shortly here in about 5 minutes or so. And what we're looking at is a 1-minute chart. And what you're seeing down here is kind of a slow, normal kind of market movement as the pre-market session comes to an end and the day session begins. So if you're thinking about whether or not you should take a large stop or a small stop, first understand whether or not the market is slow or fast. And I use this ATR, the average true range, with a setting of 4 to tell me that. So now on a 1-minute chart, I can see the market's pretty slow. It's about, on an E-mini S&P, 1 point or 4 ticks. But if I change that and I say, you know, it's too slow to trade and I want to update that to a 5-minute chart, then it changes and I can still use the same ideas, the same methods, the same patterns, the same type of opportunities, but with a different take on the market action. If now using a 5-minute chart, this is 3 points, which means 12 ticks. E-mini S&P works in quarter point intervals, so 3 points is 12 ticks. Now I know that my stop, my target is all related based on this 3 points. Now I'll give you another example. If I look back to yesterday here, and yesterday, let's go back here to yesterday, we have here the market really strong here right as the market opens, right over here. And so right as the market opens, as we get into 10 o'clock, there may be news. You see that the ATR is really, really high in comparison to what we've seen here previously. So what that means is the targets, the stops, how I manage the trade is relatable. So it's all relative. Now, on a 5-minute chart, you may say to yourself, you know what, I'm not really interested in trading under these conditions. So what you do is you adjust and you adapt and you instead go to a 1-minute chart. And using the same criteria, so this is now going back to yesterday, we can see that using a 1-minute chart, the ATR now is, instead of being above 5 points or 12 ticks, it's closer to half of that, which is about 2.5 points, 10 ticks, 11 ticks, 12 ticks. So for me, this is much more advantageous to manage the trade, to limit the risk that we're having in these opportunities that you see. And if the market begins to now get slower, as you can see, as we get throughout the day, which is normal, you can see here that now it's about 6 ticks. Now we're getting really, really slow here at about 4 ticks, 5 ticks. So now you can say, you know, the market's a little bit slow for me to get in, get out, get in, get out. We switch now to a 5-minute chart. So in order to adjust what we're doing in the beginning of the day, if the market is too strong for you, drop it down to a 1-minute chart. If the market, as the day progresses, begins to get slower and slower, again, which is normal, adjust it back to a 5-minute chart. So that way you always are in check. You're taking the maximum amount of target or stop, but without going to these extremes where the market's too slow or too volatile and it's not worth the risk. So usually when I look at these values, I say if the ATR is, and this is just referencing the E-mini S&P, there's a formula and a calculation for different markets, which I can show you guys later. But on the E-mini S&P, we're looking at the 5 points and 1 point here as these extremes. Market's too slow to trade, market's too volatile for the risk. And then that's how you adjust whether or not you should be using a 1-minute chart or a 5-minute chart, or even if you want to go outside that, let's say 10-minute chart or a 30-second chart. Even if the market's really, really strong, you can go down to that extreme. That's fine. Especially when it comes to the autopilot, we do have a 15-minute, or I should say a 15-minute and a 15-second opportunity to auto trade the market instead of just being stuck with one time frame. We can adjust those time frames as well. Hopefully this helps you understand and learn a little bit more about how to adjust the different time frames based on the volatility and the risk. If you do have any questions, or if you want to attend the next live webinar, make sure that you're signed up at daytradetowin.com on our email list. Get a free account, member account, and we'll send you an email when we have the next live webinar. Until next time, good trading. If you're new to day trading and want to learn more on the benefits of trading the markets, visit daytradetowin.com, join the next mentorship class starting later this month, and subscribe to the Day Trade to Win YouTube channel. We focus on price action and work exclusively with new and beginner traders who want to learn more on how to prosper from trading.